For those of you that have tuned into our quarterly webinar on quarterly investment market update, welcome. We're delighted to have a guest today, Dan Cervino. And what we're going to do today is we're going to look at the facts and figures of the last 3 months, but we want to put that in the context of what's happened over a longer period of time. The reason we've asked Dan to join us is he's with Dimensional, and he'll introduce himself in a second. But we've been using Dimensional for now closing in on 20 years. And the reason we use Dimensional on behalf of our clients is because they do an excellent job at harnessing the academic research, what is known about investments, what research has discovered, and we get to implement that in our clients' portfolios. So Dan, if you just want to say hello to our clients.
Yep. Good morning, everybody. So as Peter mentioned, my name is Dan Cervino. I've been with Dimensional now for nearly 11 years. As I'm sure you can tell from my accent, I'm not exactly from this part of the world. Although I'm based in the Dimensional office in Vancouver, I actually spent sort of nearly 6 years working in our London office. And in terms of my role is to work with independent and fee-only financial advisors like Peter, and sort of support them on their business and help them to provide a successful investment experience to investors like yourselves. And I was doing the same thing back in London, albeit working with advisors across Europe, and was fortunate enough to relocate to our Vancouver office nearly 5 years ago now. And so really, sorry, go on, Peter, you're going to say something.
Welcome to Canada, and also welcome to our webinar. Thanks for joining today.
Thanks. And what I was going to say was, so if we can skip to the next slide, and the plan is really to give you a bit of a summary of what's happened over sort of the previous quarter, or Q2. So whenever you see Q2 on the screen, it's referring to the second quarter of the year. And here you can look at this, and there's quite a lot of red numbers. I'm going to talk you through it. But what we're looking at is the performance for different stock markets around the world. So this is not, to clarify, this is not fund data. This is what happened in each region using sort of pretty popular indices or indexes like the Russell 3000, which represents, for instance, the US stock market, or the S&P TSX to represent the Canadian stock market. And we can see there's quite a lot of red on screen. So just to orientate yourselves, the Canadian stock market in the second quarter of 2022 had a return of negative 13%. Similarly, on the US, pretty much the same, minus 13. And on the international side, so international not including emerging markets, so that's every developed country excluding North America, returned minus 11. Okay. Now, whilst it's disappointing, okay, we can see these red numbers, it's important to put this in context of history, and that's what we're doing in the table beneath. And so if we go right to the bottom of the screen, what we're doing is we're now looking at a longer data set, so going all the way back to January 2001. And the reason we go back to 2001 and we can't go back further is because that's when emerging markets data starts getting introduced. And you can see in that bottom row, what we've done is we've highlighted the worst quarter on record for each of these regions. So bottom far left-hand corner, if we can just pop the mouse over it, we've got minus 22. And that was in the fourth quarter of 2008. And we all remember what 2008 was like. And in that quarter, the Canadian stock market did minus 22. Okay, so we look at the last quarter in 2022, negative 13, very disappointing, but not quite as bad as Q4 2008. Interestingly, you look at the US, and actually last quarter was the worst quarter certainly since 2001. On the international side, again, 2008, albeit a different quarter in Q3, returned negative 16. Now, one of the things we want to focus on is not just placing the quarter in terms of the long run history, but the reason we're doing that is we are long-term disciplined investors. And so what we're going to do on the next slide is we're going to actually extend that time horizon beyond just Q2. So again, just to help you out with what you're looking at, we're now looking at the period ending June 30th, 2022, and we're going back 12 months. So this is not calendar years, 12 months going back from June 30th. Okay, and you can see that top line is showing you that 1 year return. So again, all red, but the numbers, they're not quite as severe, certainly on the Canadian stock market. So it's down -3, the US down -10, international -14. Now, I mentioned just then the importance of being a long-term disciplined investor, and we can see that if we go to the next line out, where we extend our time horizon only out to 5 years, and we can see we now got some green, and green across the board. Okay, green is good, and actually we've got some pretty meaningful numbers. So what we're looking at here is the Canadian stock market for the 5-year period ending June 30th, 2022, returned 7%. And these are annualized numbers. So what does that mean? That means this was the return year on year. So for each year for 5 years, the Canadian stock market did 7%. The US did 10% and international 2%. We then extend that out 10 years and we see the similar relationship of 8%, 15 and 7%. And the reason we're showing you this on the screen is to really highlight the importance of sort of maintaining that discipline, because ultimately markets reward disciplined investors. You want to be in your seat, you don't want to panic, and you want to focus on the long term. Now on the next slide, Peter's actually going to drill down and talk you through what actually happened in the Canadian stock market for the second quarter of 2022.
Thank you, Dan. And this is a great slide because this sort of shows our investment philosophy. Look at the bottom left-hand part of this slide. See the round circle? Well, that's the world. And there are probably about 16,000 companies, publicly traded companies you can purchase in the world, plus or minus 1,000. And look at that little orange sliver. That represents Canada. If you are looking at investing and diversifying your portfolio and you only buy Canadian stocks, we represent, in the world context, we only represent 3% of the publicly traded stocks. So if you put the lion's share of your money in Canada, you would not be having diversification. And long-term history has shown that you get a better return with less volatility, less ups and downs, less risk if you're diversified. That's a strong part of our philosophy. The second part of our philosophy that I want this slide to bring out is that we believe what the academics have researched over the last 60, 70 years to be true about investing. We want to use and harness what is known about investing. So our portfolios typically are weighted a little bit more value-oriented versus growth-oriented. And up in the top right, do you see how there's a -9%? If we can get the cursor up there, that's a value investment. We think values, well, 70 years of research thinks that value investments do better over time. Now let's come down to a growth area. They lost 17%, far more than the loss of 9%. So in the last quarter, things worked out the way you would have thought they would have worked out in advance of the quarter starting. But that doesn't always happen. And to illustrate how it doesn't always happen, let's talk about big companies, small companies. Small companies have a higher expected return. There's more risk in a small company than a big company. Therefore, the market has to provide a better return. Otherwise, people wouldn't invest in small companies. But look here, you've lost 20% in the last quarter in small, and only lost, now only it's still a loss, but relative to the 20% negative, you've only lost ballpark half of that at 12%. So that highlights our philosophy is to go what's known with research, go what's known with studying investment results for decades and decades, but realize that it doesn't happen every year. But when we make a decision every day, every month, every year on how to invest, we take what's known, and in most cases, it's going to work out to our favor. In the long term, absolutely, it has certainly in the past, and we anticipate that will continue. So those are the two things that we wanted to talk about on that slide. And going to the next slide and continuing the idea of international diversification, Dan went through the last quarter returns for Canada, the States, and other parts of the world. What you're seeing in those bars are different countries. And you can see they basically almost all lost money. They're all going down. The middle, the dark one, highlight the dark one, that's actually the average. Canada, as it turns out, is just next door to the average. So you lost money across the board, but you see how you lost different amounts of money. And if things had gone up last quarter, you would have seen different amounts of money being made in certain countries. That's why you diversify. You know, being an investor looking at past results is easy, but anticipating what's going to happen in the future, being a long-term disciplined investor requires you to spread your money around. And Dan, I've looked at the countries, virtually all of them, that didn't do so well. Why don't you take the glory road and talk about the two successes we had?
Yeah, we talk about sort of a global opportunity set, and just to clarify, what we're looking at here is we've ranked country returns from the most positive on the far left-hand side to the most negative on the right. And as you can see, there actually in the last quarter, there were only actually 2 countries that had a positive return, and those were actually China on the far left and Hong Kong. But Peter's absolutely right. The point is we have no way of identifying in advance which countries are going to be the top performing or worst performing, and so we don't engage in this sort of this timing or sort of this switching, and so we just harness this global opportunity set and sort of those collective returns globally. And just to clarify, as far as I'm concerned, there's nothing average about Canada. So if we can go to the next slide, please. And Peter spoke about this idea of risk and return being related. And that's sort of one key fundamental part of investing. And another part of that is obviously diversification. We're all comfortable with this idea that you don't just want to put all of your eggs into one basket. And that's really what we're looking at here. Now, what I want you to think about is this idea of whiskey and water. Okay, and we're diversifying across both. And so the whiskey, this is going to be your equity portion of your portfolio. The reason it's the whiskey is because it's the punchy part. It's designed to generate the returns. The water, this is your fixed income, or these are your bonds. Again, the role of that is to dampen down the volatility, make it less punchy, or make it weaker. And the extent to which you mix the two is going to be the main driver of your investment journey and ultimately the risk return profile of your investment portfolio. So if we look at that bottom chart, and this is what's called a growth of wealth chart. And so just to clarify, if you were to invest $1 at the start of January 1994, and you put it in 100% bonds or only water, by the end of 2021, you'd have $36,000. Okay, so it's a pretty decent return. Okay, but you can see it's a pretty smooth journey. Now, for some investors, this is an entirely appropriate portfolio. Okay, particularly if your goal is capital preservation, or perhaps your investment time horizon is a little bit shorter, or indeed your risk appetite, actually you don't really have much of a risk appetite when it comes to investing, or a capacity for loss, for instance. So that's the extent to which your portfolio might drop over a quarter, over a year, or over 3 years. Okay, and then each of those lines, as you increase, is just increasing or introducing a little bit of whiskey or introducing more equity into the portfolio. So going back to what Peter was saying, there's no getting around it. Risk and return are related. So if you want to generate higher returns in your portfolio, you've got to introduce more risk or introduce more equity. Okay, and the extent to which you combine those two, this is where Peter and his team come in. They sit down with you, they understand your goals, they understand your needs, they understand your investment time horizon, and they will create a mix of equity and bonds, or whiskey and water, that is appropriate for you and your family.
Before you leave that chart, I'd like to add on, and you basically said that the risk, the stock is more risky than the bonds, and therefore it gives you higher bad years, lots more dips, but it does give you a better return. One of my observations over the last quite a number of years, back in 2008 and 2009, not only was the world plummeting stock market wise, but the world was just in chaos. There was absolute fear going on. And there was a lot of discussion about what companies would be allowed to go broke, and the government certainly couldn't allow these big companies to go broke because they were so darn important. And as I would read in the morning paper these articles about, people pleading, don't let me go broke, I'm saying, no, you've got to have the opportunity to have a company go broke, which is the investment risk. Now, our clients own about 12,000 stocks. So if one goes broke, it's no harm done. But you've got to have that risk, because if you don't have that risk, you're going to be low risk. And you can see what happens with a lower risk bond. The $1 doesn't amount to very much over a whole lot of years. Whereas in stock, when you take on that risk, and if I can just say, it's almost not fair to our advantage, for our client's advantage, how risk works, because risk is measured on a 1-year basis. And if you're going to hold through good times and bad times, you're really not subjecting your time, you're subjecting yourself to taking risk. So when people say, well, I wish there wasn't as much risk in the stock market, oh, no, that's exactly wrong. You want to have the risk, but you want to be aware that risk is going to happen and manage that risk accordingly. Just wanted to, Dan, add that point on this chart.
No, that is an excellent point. So what we're going to do on the next slide is we're actually going to look at another growth of wealth. But what we've done is, and you can see here, it says crucial lessons for weathering the stock market storm. Now, one of the things that you're hearing or reading a lot about at the moment is this idea of, are we heading into a recession? Are we in a recession? Are we coming out of a recession? And what does that mean for my investment portfolio? And so what we've done is we've taken that 100% equity portfolio, so that all whiskey, and we've overlaid it in US recessions. So each of those green bars are US recessions. And the key lesson here is that a recession is not a reason to sell. Okay, and there's a few sort of principles I want to introduce here. I'm sure you've heard Peter and his team talk about. One is this idea that the stock markets are forward-looking. So what do I mean by that? Every single day, buyers and sellers are coming together in the market and they are transacting voluntarily. So now, as an investor, you're looking out into the future saying, what do I expect to receive in the future? And what am I willing to pay for that today? And that might be determined by a myriad of factors, one of which is absolutely going to be economic data. But economic data, by definition, is backwards looking. Okay, so it's kind of, if you were just to rely solely on economic data, it's kind of like driving, just looking in the rearview mirror. But the key takeaway here is you can see the importance of maintaining a long-term disciplined approach. And so if we focus on the right-hand side of the chart, you can see there's two most recent recessions. We've got 2008 and 2020. Now, obviously, at the time, these are extremely, they can be extremely anxiety-inducing or stressful. But if you had done what a lot of investors did and you'd panicked and you'd taken your money out of the stock market, you wouldn't have participated in the subsequent recovery. Okay, and actually, when you zoom out and look at the long-term picture, you can see market dips like 2008 and 2020 end up being relatively small blips in that longer term journey. Peter, is there anything you want to mention on this slide?
No, that's pretty well it. And I was looking at the 2007 recession. You see how the market, I don't know if the cursors can get up there, but how the stock market declines during that recession. But while the recession is still going on, again, you're saying the market is forward thinking, it doesn't care what happened yesterday, it's looking next year. And the markets in all these ones that I'm looking at are the ones I can see. Some of them are pretty small. Basically, by the time the recession ends, the market's already been going up. So the idea of, I think I'm going to wait for things to get good, well, that's okay, but this doesn't bore up if you look at the last 100 years.
Yeah, and this, if you had, as an investor, you had panic and you're taking out, sometimes the anxiety of being out of the market can be just as stressful as the anxiety of being in the market. Because if you had taken your money out when the market gone down, what have you done there? You've essentially bought high and sold low. There's a very good way, or a very good shortcut to wealth destruction rather than wealth creation. And I actually, to Peter's point, I actually pulled the numbers prior to this session. And what we did is we looked at the returns in stocks in the 2 years following a recession. Okay, so a recession ends. What did the stock market do in the 2 years following? Well, 73% of the time, the stock market's had a positive return. And that's exactly to that point that Peter.
Oh, there we go. There's the slide.
So actually, just go back to the previous slide, sorry. And then So in those 2 years, the average return over those 2 years was actually 7.8%. Okay, so that's coming out of each of these green bars. So that answers the question, okay, do we need to panic and do we need to sell during a recession? And the answer is no. We need to maintain that discipline, focus on the long term. Now, a logical next question is, okay, well, what happens if the stock market goes down? Surely that's a good reason to sell. And that's what we're looking at on the next slide. So what we've done here is, again, we've taken the US market because it's the biggest and got the most amount of data, and we've gone back to 1926. And those 3 bars on the left side, on the left-hand side, have showed you the return of the US stock market following a 10% market decline. So what happened every time the market went down 10%? What was the average return on the following 1 year, 3 years, and 5 years? And you can see the average 1 year return following a 10% market decline was 12%. The average 3-year return was 34%, and the average 5-year return was 68%. So this is really reinforcing that point of how you want to maintain that exposure and discipline so that you can participate in that recovery. And this idea that I said, being out the market can be stressful sometimes as being in it. Well, if the market's gone down 10% and then it suddenly shoots up 12% and 34% over a 1 and 3 year period, and you're not investing, then that can be extremely anxiety inducing. And you can see it's much the same on a 20% market decline. We see a similar relationship, and on 30%, where you can see by maintaining that discipline, that focus on the long term, it allows you to have a successful investment experience.
Part of what we do with our clients, Dan, all clients have an investment policy statement. And think of that as the architectural design. If you're going to build a house, you have an architectural design on what you're trying to build. We do the same thing with investments. So what are we trying to build? And in that document, we include what a portfolio like this would have done over previous years. And it's important in that document to highlight that sometimes things go down in value. That is part of investing. You have to know that every once in a while, things are going to go down. And I think if clients are aware that this is just a normal part of investing, then they'll take it more in stride. And I've noticed, and you've probably noticed, because I've heard this from investment professionals for the decades, when things start going bad, the news media hops all over it because there's all sorts of psychology reports saying that, there's more credibility given you're giving doom and gloom news. So news is typically bad stuff. And so when bad stuff happens, they can kind of magnify it and think pretty well everybody figures the world's going to end. It's important to know things do go down. That risk gives you a better return. You should be aware that things will go down from time to time so you don't panic. So that's just a little add-on to your chart.
Yeah, you're spot on. We always talk about sort of the key tenets of a successful investment experience being, okay, well, diversification is your friend. So we want to be as diversified as possible. Risk and return related. There's no getting around that. Where possible, we want to keep fees and expenses as low as possible. And then a key part of being a long-term disciplined investor is this idea, as you were saying, tuning out the noise. Because unfortunately, there's a lot of noise out there, because the reality is Forbes and all these other magazines wouldn't sell very many covers if every single month the headline was do nothing, stay disciplined, focus on the long term. And so you've got to learn to tune out that noise.
Yes. And you find in the media, and even sometimes in the investment community, but certainly in the media, they start saying things that would indicate that, yes, if you're only smart and spent some time thinking you could outguess the market. That doesn't actually happen, but there's a lot of time given for that in the news media because people like that kind of, I could have figured it out. They like that kind of news, and that they therefore buy that kind of newspaper magazine.
Yeah, it's like gamblers. Everyone likes to tell you about the wins, but they don't really tell you about the losses.
I hear that all the time. No one's ever, here's what I did 20 years ago. Well, tell me the rest of the story. Well, I guess we're getting close to the end. Again, thank you, Dan, for joining us. And thank you to our clients that have joined in. If any of our clients have any questions about today's presentation or couldn't read the fine print about where some of our sources came from, I'd welcome your email or your phone call. I'd be very happy to chat. If there are people watching this webinar that are not clients and would like to speak to us about that possibility, I'd always welcome an opportunity to chat with you. So thank you to our clients for watching. Dan from British Columbia, thanks for participating.
No
With
problem.
that, we'll end this quarterly market update and see you all sometime in end of October. Bye for now.